You have to have a really solid understanding of the securities laws that you are following, because it's not just one securities law. There's different exemptions. Well, if we just back up a little bit, talking to people who don't even know what the word security is, what's a security? Well, a security is when you're selling interest in your company to other people in exchange for their money, and they're relying on you to make a profit. That's really kind of the just simplest way that I can state it. Or people who are in the business of repeatedly borrowing money from people are also in the syndication business. They just don't know it. So anytime that you're asking people for money and they're expecting you to generate a profit is when you've fallen into the realm of securities laws. And what that means then is now that you're selling, so you're selling securities. And if you're going to be selling securities, you either have to register your offering, which means you have to go get pre-approval from a regulatory agency before you can even ask anybody for money, or you have to qualify for an exemption from registration. And so the registration process is what companies go through when they do their initial public offerings. So you don't want to have to do a public offering. You can't afford to do that for real estate because it takes too much time, it costs too much money, it's not necessary. So your alternative is to choose an exemption from registration that will allow you to talk to people without having to get that pre-approved offering. And so there are a lot of different exemptions. There's exemptions at the state level if you were doing things all in one state and you weren't going to be, the properties and all your investors are in, say, Texas, then you would probably want to follow a Texas securities exemption. But if you're going to be crossing state lines and bringing in people from other states, you're buying properties that are, outside your state, then you will probably be looking at one of the federal exemptions. And there's several choices that you have at the federal exemption level. There's two that are very, very common. Both of them are called Regulation D, Rule 506, but then there's two subparts to Rule 506, and you can choose between the two. The Rule 506B exemption is the original exemption that's been around since the 1980s, and thousands of people have used it over the years. It's the same exemption that giant hedge funds use to raise billions of dollars. That exemption, however, doesn't allow you to advertise. It only allows you to ask for money from people with whom you've already have an established pre-existing relationship. So you can't post it on the internet. You can't stand up in front of a real estate investment club and say that you got a deal if you're doing this Rule 506B exemption. So the reason that people like the Rule 506B exemption still, though, is because it's the exemption that allows you to invite your family and friends, some of whom may not be accredited investors. So you've got accredited investors, people who have over $1 million net worth, or they make $200,000 a year income if they're single, $300,000 if they're married and file joint income tax returns. So that's the accredited investor. And you have people who don't meet those financial qualifications, and those are non-accredited investors. Well, with the 506B exemption, you are allowed to bring in up to 35 non-accredited investors in your deal. And most of our clients who've never done this before really need to focus on that group of non-accredited investors, because that's probably the people that they know who will invest with them before they actually have experience and a track record. The people that already know, like, and trust you are more likely to invest with you than people who don't know you, because the first thing people who don't know you want to know is what's your experience. So the alternative to that Reg D Rule 506B is the other exemption, that's Reg D Rule 506C. Okay, and this 506C exemption does allow you to freely advertise your offering, but you no longer can bring in the non-accredited investors. All of the investors have to be verified accredited investors. So the biggest mistake that people make early on is they don't understand the difference, and they advertise their offerings when they want to be able to bring in non-accredited investors, or they advertise their offerings and they don't know they can't bring in not accredited investors, either one of those things will blow the exemption so that you're no longer entitled to claim it.